Welcome to Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors. And in this episode, it's part 2 of the 2-part series we have with Jay Andersen from Jay Andersen Property. We talked about building that foundational residential portfolio and how he goes about that in episode 1. Episode 2 is focused on the commercial, which he sees as the natural progression for investors that are wanting to set themselves up with a passive income. So he talks to us about the price points that he looks at, what he considers when he's looking at the potential of a commercial property, with a particular focus on some of the subsets within commercial that attract his attention the most. An awesome interview with Jay where we're just scratching the surface of commercial due diligence, but it should be a great 101 for anyone wanting to get in that space. Here's Jay. Jay, thanks for joining me back for part 2 of our special episodes. How are you doing?
Very well, thank you, and pleasure to be back.
So where we left off last time was your insights into building a residential portfolio. And of course, we talked about, the foundational assets, the development upside assets, how cash flow kind of figures into your ability to grow when the banks are getting their nose into your financial situation. But the trajectory were obviously headed to commercial as being the point where once you have a foundational portfolio, commercial is a great area for investors to target. I want to start with, why is that the case? Why is the goal to get to commercial if you want to start building a serious portfolio that's going to help you with passive income?
Yeah, and I think a lot of it comes back to what we spoke about in that last episode around, working out what the end goal is with investors, and early on it's wealth creation, building an asset base, but almost, in all cases at the end, people talk about, a passive income, being able to stop working or have the choice to work, and then having a passive income. And that obviously then opens up a whole range of different opportunities. So to get that kind of passive income that someone needs to be able to step away from their job, to get that in a resi portfolio, you need a seriously large portfolio. So to hit those numbers is actually a lot more achievable to do it in a commercial portfolio. And then, you kind of have a look at what the bigger players in this kind of space do, the high net worth, the ultra high net worth. A lot of them do have that resi portfolio, but a lot of their focus goes into that commercial, so they can get that cash flow, and then that opens up a whole range of different opportunities, not only personally, but for continuing to grow the resi portfolio. It just gives you a lot more options. So that's kind of where most investors end up, focusing towards commercial later on in the portfolio.
Beautiful. And you left us off on the previous episode sort of talking about commercial for you has really kind of an entry point of the $1 to maybe $1.2 million plus. Now, of course, you can get in for perhaps as low as $300,000, but in your view, the risk-reward ratio is not sufficient pre that mark. So can you rehash that ground?
Yeah, it's really about, I guess, some of the key things we want to focus on. And I guess this is where it gets quite different to resi. We do put a lot of focus on the lease agreement and the tenant themselves. So in resi, it's more, I guess, about the location and the property itself. But on commercial, there's a really strong focus on the tenant and the lease itself. So to get really good quality tenants, long leases, good area in a good industry, just once we start ticking those boxes, those smaller, $200,000, $300,000, $400,000, $500,000 commercial properties just don't hit the mark. So, when you're looking at commercial properties and, you sometimes got leases 5, 10, 15, 20 years long, it's really important that we've got a tenant that is going to be very profitable in their business and want to stay in that location, in a sector that's going to, weather any storms and have a lot of stability around it.
Yep. Now, when it comes to commercial, I suppose it can be broken up from a price point of view, but perhaps even more meaningful is an industry point of view. Are we talking office? Are we talking retail? Are we talking medical? And there's a few areas that probably disproportionately occupy your mind in the commercial space. Can you run us through the areas that you've had success and where you tend to transact with your client base?
Yeah, I guess our core focus with our portfolio and our clients' portfolios is healthcare. And once so healthcare can be broken down into a number of different subsectors from, pathology, dental practices, primary health, so medical centres, and then you can get into some of the bigger stuff like private hospitals, day surgeries, even some aged care. Outside of that, childcare is another sector we've been very active in. We can kind of dive into that in greater detail in a moment, but I'm sure everybody knows how hard it is to get a child into childcare and how expensive it can be. And then the third one is the hotel, motel, accommodation sector. So there are kind of our three core focuses. There is obviously office, retail, hospitality, industrial, a whole lot of other stuff. But they're definitely our core focus at the moment is those three categories.
I wonder if I can sort of characterize what I think they have in common, and you can rate me as to how good of a commercial property investor I might be. These are industries perpetuated by kind of a resistance to any kind of downturns, right? Like medical services is propped up by the government to some degree. So thankfully in Australia, as distinct from the US, we have universal healthcare. Medical practices tend to be places that the setup cost can be quite significant, and just the public knowledge of that's where that practice is or that's where that hospital is has a tremendous value, and the cost of kind of moving around to customer retention and fit out is a big one. Motels maybe doesn't fit in that category as perfectly as, say, the medical and the childcare, but how much of that kind of factors into why you see those areas as being so valuable?
Yeah, a lot. And I guess if we kind of break down those three, healthcare, if we talk about medical centers, just as an example, if we look at some kind of key tailwinds behind a sector like that, we've got obviously an aging population. The life expectancy is, increasing. So demand on healthcare and medical services is forever growing. If we have a look at some population forecast projection and tying that into kind of healthcare, medical related services over the next 40 years, the age cohort of 65 plus is projected to more than double, and 85 plus is projected to more than triple over the next 40 years. So where that gets a little bit interesting when you start diving that down is 40% of expenditure in healthcare has been done on people ages over 65 and above. So when we start looking at locations and where, we get really kind of into the nitty gritty, having a look at, current demographics, forecasted population growth, having a look at different age cohorts. On medical, as I guess most people know, it's either the elderly or the really young that are kind of reliant on a lot of healthcare and medical services. And obviously, a lot of government funding and backing in a sector like that. As you touched on with healthcare, they're really we call them sticky or anchor tenants. They're tied to that location. If medical center picks up and moves 2 suburbs across, they might lose 95% of their client base. The same can be applied for childcare center. If they pick up and move 2 suburbs, there's some really interesting data around kind of childcare and medical centers about kind of commute time. There's kind of a 14 to 16 minute radius around a place like that of where people will come to that property. Yep. So if it picks up and moves outside of that area, they might lose 95% of their client base. So they're kind of really reliant on location, which is obviously something that we want as a landlord. We want a sticky tenant. Medical's very, very interesting in that space. Obviously, the tenants themselves are high income earners, so it's not a mum and dad operation. They've mortgaged the family home to open up a cafe, and it's their first time trying to do it. They're doctors. A lot of the times, the tenants themselves, the operators of the medical center, it might be 4, 6, 8 doctors that are collective all put together. And then there's different succession planning on, selling out their share when they retire to a younger GP. So they're kind of really, really sticky tenants, which is great. Um,
And I wanted to ask a question about lease terms as well. I
yep.
mean, because of the stickiness of the location and those amazing stats about, what sort of churn they could have if they move, I'm guessing that then perpetuates longer lease terms, and that's the demand coming from the tenant and obviously a benefit from the owner of the premises.
Yeah, and I guess from the tenant side, the fit out costs can be huge. Especially if you're talking medical, and if they're doing if it's a larger medical center and they're doing medical imaging and stuff like that, fit out costs can be very, very expensive. So there's the tenant obviously wants to stay in that location for a long time as well, as much as the landlord does. So on a medical center, kind of a typical lease that we might see might be a 10 plus 10 plus 10. So 10-year initial term with two 10-year options. We can get stuff that's longer than that. Once you get into the bigger healthcare assets like private hospitals, day surgery, stuff like that, they can be 20, 30-year leases, initial terms. And then you can have, sometimes 4 10-year options beyond that. So in terms of the length of the lease, they're very, very long, which is obviously great. Childcare centers, typical starting lease is about 20 years, and then you might have 2 10-year options. So leases are very, very long, and motels, typical lease would be 30 years broken up into different terms.
One thing we see in the residential space is that the shorter leases, let's say a succession of, let's say, 6 one-year leases on a premises, at the end of that period, the market rental is likely to be much closer to what the actual rent paid is. Whereas if you have, say, a tenant in place for 6 years during that same period, I think we can kind of see in the data that it's likely to be rented under market value. It's almost like a tenancy change is a great opportunity to increase the rent. Now, with these long lease terms in commercial, how is that kind of factored in? And do we actually see, sub-premium returns based on that tenure?
Great question. So one of the things we always have in a commercial lease, you'll obviously have your annual reviews. So typically they'll either be a fixed increase, so it might be fixed by 3% a year, or it might be by CPI. Sometimes it's CPI plus 1%. Sometimes they'll have, it might be CPI plus 1%, but there'll be a cap and a collar. So what that means is basically it might be, as a minimum, it needs to increase by 2% a year and maximum by 5% a year. So there are our annual increases. And then at each option term, or it might be every, let's say, 10 years or 5 years, there'll be a market rent review. So at that point in time is when you either, provide data around where you think market rent should be for a premises like that, or you get an independent valuer to come in and assess that. And on the market rent review, we would always try and have what we call a ratchet clause. So basically, rents can never go backwards. So even if a market rent review was done and it said, well, rents actually should be less than what it is, well, there'll be a provision there to stop rents ever going backwards. But really, it's those market rent reviews that help us, ensure that it's in line with whatever market rent should be.
The lease term on an investment purchase in the residential side of things is often doesn't factor in too tremendously, right? If you're acquiring a property with a tenant in place, you just kind of want to make sure that it's close to market rent, but you're prepared for the fact that certainly in the situation we're in at the moment, you can't expect too much in terms of vacancy. Whereas with commercial, it does sort of seem like the contract that's in place for the building has a disproportionately high value compared to the structure that it's in. How would you sort of contrast the two?
Yeah, definitely. I think, with commercial, well, really, it's the number one reason we would reject a property or terminate a property under due diligence for a commercial property will be around the lease and the lease terms. So every lease is kind of unique. So it will not only cover things like how long the lease is for and the standard stuff like rent increases, rent reviews, but also get into nitty gritty of responsibility and obligations regarding, it might be repairs and maintenance. It might be landlord funded works. There's basically a different range of things. But there's a lot of emphasis and focus on the actual lease agreement itself, when in resi, for the most part, whichever state it's in, it's pretty much a standard lease. So there is certainly a lot of focus onto the actual lease itself in commercial.
Yeah. I just want to change directions quickly. The commercial kind of naysayers will say, "Oh yeah, commercial property is great because it gets higher yields," and they talk about net yield rather than gross yield, which always smashes the residential yields to smithereens. But people would say, "Well, that's only the case because of the high risk of vacancy. You know, we've got national vacancy rates in the residential space at 1.1, and I'm sure that there are some sectors of commercial that are double digits at the moment." How do you kind of retort that sort of line of questioning?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, well, using motels as an example is a great one to answer this one. So the tenant themselves in a motel actually buys the lease. So, you know, let's say if we just say a fairly standard motel in a regional town, the tenant themselves might have paid $1 million for the lease. So they've put in a fair chunk of capital up front to actually acquire the rights to the lease. So it's always in their interest, you know, if it's a 30-year lease, they might run the business for 5 years, 10 years, whatever it is, and then they'll look at on-selling the lease. Even if they were losing money on the business or it wasn't profitable or, you know, a big change in circumstances, at very least, they'll be looking at, you know, recovering cents of the dollar of what they outlaid. So they outlaid $1 million for that lease, even if they sold it for 250 grand or whatever it may be to somebody else. They'll be looking at on selling the lease. And then a lot of these commercial leases have, you know, step-in rights as well from the bank, you know, if they've done borrowing, where the bank will basically step in, put managers or operators in place to keep the business operational until they can look at, you know, selling it off to somebody else. So if we look at, you know, kind of my own portfolio, my family's portfolio, we've never had vacancy in any commercial property. Right. But, you know, had plenty of vacancy, you know, 2, 3, 4 weeks, whatever it is in resi, but never in commercial. And that's where I think it's really important to understand not only the industry, the subsector it's in, the tenant, getting a really deep understanding of the tenant's business. You know, there's certain kind of metrics we look at, like in childcare, we want the centre to be operating at a certain percentage of occupancy. Yep. We want to look at things like childcare ratios. So how many kids are aged between 0 and 4 in that catchment area versus how many childcare places there are. So we obviously want that childcare ratio, you know, supply and demand. So there's a number of kind of metrics we look at whilst you're doing due diligence to understand that. You know, if we look at things like private hospitals or the big healthcare stuff, you know, we want their profit to be at least double what the rent is. So there's a whole lot of kind of metrics we can go through to, I guess, prevent or minimize any kind of vacancy risk. And then the other thing we always go through whilst looking at a commercial property is say, well, let's say worst case scenario, you know, the plane's going to crash. Worst case scenario, the tenant vacates, doesn't renew their lease in 10 years' time. What can we do with this property? You know, if it's a big medical center and it's a single tenant, but they've got, you know, a number of different consultation rooms, they've got medical imaging, they've got pathology, they've got some other space. Could we lease spaces out separately and get some allied health, get a smaller medical center in there, get a dental practice? What's the demand in that, you know, in that market right now for a scenario like that? So it's basically going, you know, what's the worst things that could happen and what measures could we put in place to either minimize that impact or avoid that scenario unfolding?
That's far more sophisticated than perhaps people dipping their toe in the water of commercial would hope or expect, maybe both. Before I do ask you some of the key things that you look at, I want to just contrast the drivers behind the residential property market and the commercial property market. You know, it's probably too short of an episode to talk about all the drivers of residential, but we sort of tend to know those fairly well. Whereas with commercial, it does kind of seem like it has an exposure to interest rates, because we're at a point in the cycle where interest rates are, probably fairly high compared to their long run average, or in real terms, maybe not that much, but the trajectory is probably down over the next couple of years. But you're getting investors that have a capacity to have cash in the bank and actually get a return, which was a crazy notion, a couple of years ago. And that has an influence on the appetite of investors to get into the commercial space, right? Because there are higher risks in investing in a commercial property than they are, say, putting it in a term deposit in one of the big four banks. So what does tend to have the biggest influence on driving, say, commercial from a capital growth point of view?
Yeah, so I guess from a capital growth point of view, the value of commercial property is really pegged in relation to the rental income. So if we look at it from that perspective to begin with, it's really, as a landlord or as an investor, we always want to look at what can we do to increase the rent, because that's going to have immediate impact onto the capital value of the property. So there are kind of different things we do with investors, from landlord funded works to, installing solar, and basically reducing the tenant's cost of electricity in return for a slight increase of rent. That's a really interesting thing to explore. There's also stuff like landlord funded works, where let's say it's a medical center or, a motel or whatever it may be, approaching the tenant and saying, hey, if we're able to put in, whatever it is, let's say $200,000 into the property, we might repaint the outside. We might add some extra consultation rooms in the medical center so they could have more doctors, basically working with a tenant to say, hey, we've got some money we're willing to spend on the property. We want to spend it on the property, which you will get the benefit of in terms of, your business. We're happy to spend that money, but in return, we want the rent to go up by this much a year. Yep. So you work out a win-win scenario, obviously for the landlord and the tenant. But anything we can do to get that rent going up is going to have a direct impact on the value of the property. Interest rates, commercial is really interesting in the fact that we kind of really break it down into different price segments. And there's a lot of different influences in different price segments. So at the moment, if we look at, say, really sub 5 million, it's a lot of mum and dad investors. Yep. And on one hand, you could say, well, yep, they're probably impacted by interest rate rises, more than, let's say, the big funds or anything like that. But in the childcare space, as an example, there was a childcare centre in Lower North Shore that sold, I think it was last month, at 4.14%.
Oh, wow.
So, as an investor, they could be getting more money in a term deposit, but that's looking at right now, this point in time. If you start peeling the layers back and go, well, that's a 20-year lease, it's in a blue chip area, I'm sure that's not that purchaser's only asset. Yep. They've probably got money in, all different kind of asset classes. But for the most part, we're seeing childcare centers still trading at the moment at kind of 4.5 to, up to 5% once you go more regional. Yep.
Blue chip asset, right?
Yeah,
so
long leases.
Yeah, a bit like sort of Sydney's eastern suburbs. You're not going to get 5 or 6% yield on anything in that area, right?
Yeah. What's probably more interesting is, and then you have a look at different price segments, and once you go the lot bigger segments, so where you start playing into the, the area of the big property funds and the REITs and stuff like that. So if you're looking at stuff of really 20 million plus, and obviously we're talking big numbers here, but if you start looking at what's happening in that sector, a lot of the funds bought really aggressively during COVID when cap rates were really low. Like they were buying stuff at 4.5%. They might have had target fund distributions at 4.5% as an example on a 5 or 7 year term. Investors are now getting 5.4% into term deposits. A lot of investors are saying, hey, we want our money back.
Yep.
So a lot of the funds are looking at having to sell some assets and free up some cash. So there's actually, really good buying opportunities there.
Get in touch. We'll pool our funds and see if we can get 50 or 100 mil together.
yeah. And that where those price segments start and stop, what I've noticed over the last kind of, 5-10 years is those numbers kind of change. So it's really important to really stay on top of kind of what's happening in the market regarding different transactions and different sectors within commercial property.
This episode is going to run out of time to get even to the very basic level of your due diligence. And I should say that we recorded an on-demand webinar a couple of years ago on commercial due diligence, and I don't think anything that was discussed is not applicable today. The numbers may just change a little bit, so I'll try and put that in the show notes. But if you could talk us through, I don't know if there's a top 2, a top 3, a top 5 of key things that you look at, because you mentioned that the lease was a huge consideration. Obviously, we need to make sure that the building's in a certain level of repair, and that's probably the easiest thing to get our head around. But what are maybe your top couple when it comes to the first filter of like, am I even going to dig deeper into this?
Yeah, look, definitely the first thing is understanding the lease. And I think I've read thousands of leases over the years, and they're all different and very, very unique. So it's really important to, read through the lease in detail and really try and understand the responsibilities and obligations, and map out a whole lot of different scenarios as well, just to understand the who's responsible for what and what impact that has. I always like to look at a commercial property, a tenanted commercial property, through the lens of I was the business owner and I was the business operator, and have a look at that location, that market, that industry. And if I was looking at it as buying the business, what would I be happy about? What would my concerns be? Because at the end of the day, we want the tenant to do really well in their business. That means they're going to pay rent on time. They're going to invest back into the property. They're going to be there for a long time. So it's really kind of important to look at it from their lens as well. And yeah, I think they're probably the two big ones to look at. The lease is definitely the most important one. And then just, really understanding that sector and that industry, because there's a lot of moving parts to it, and there's a lot where you can go wrong if you don't know what you're doing.
Yeah, and that's something that I wanted to finish on. For property investors, often there is this kind of notion that I want to get a couple of properties and then I want to become a developer, or I want to get a couple of properties and I want to go into commercial because that's where it's at. And you've obviously helped a lot of people with that transition, and we've unpicked a couple of things today, just really scratching the surface in commercial due diligence and analysis that maybe would have people think, gosh, there's a bit in this, and I certainly recommend engaging a professional for it. But for the people that come to you with a notion of like, yeah, we got to get into commercial, where are their heads at rather than where they need to be?
I think actually with commercial, I think it's because it is very different. I found most investors, I guess, realize and recognize that it is very different and they don't know what they're doing. I think where a lot of investors make the mistake in resi is it's very easy to get advice on property from your next door neighbor or your uncle, or, someone you're chatting to at, your kid's soccer on Saturday, or whatever it may be. Everyone's got an opinion and everyone thinks you're an expert in resi. I think once you get into commercial, there's not as much of that conversation happening with next door neighbors and whatnot. So I think people do realize that it is a completely different beast on its own. So for the most part, all of my communication and contact with investors looking at making that transition has definitely been, hey, we understand that this is very different and a lot bigger, and a lot more open to, I guess, getting professional advice from the get-go.
Well, that's good to hear, because the stakes are pretty high when you start getting into those commercial properties. And even from the resi point of view, there's a strong argument to say that if only 72% of investors own one property, then there's a tremendous opportunity to get that wrong as well. But at least there's a little bit of a fear factor with commercial. But of course, that can be overcome with working with an expert. And thanks for sharing just the tip of the icebergs of the considerations that you make in that space, Jay.
No, it was a pleasure, and I'd love the opportunity to dive a lot deeper into it later on.
We'll get you back. Cheers, Jay.
Thanks, mate.